This is The Unthinkable. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the Israel conflict is sparking economic chaos as a major economy is collapsing. Plus, we have renewed signs that the global economy is grinding to a halt at a time when central bankers remain absolutely clueless. And if you're wondering what we're doing in Germany today, well, it's the epicenter of what you're about to see is the unthinkable. And with that, let's over to Bloomberg, where we picked today's story up with a headline: Canada retail sales are flat, cementing October rate pause. And it's all about the global consumer now. If we start looking around the world, what is the issue we're facing? It's inflation. And what do we need to see? Consumer demand go down. And we haven't seen that quite yet in the U.S. I'm going to make the case of why that is coming, why we're about to hit a wall at some point in the data here. But let's take a look at what's going on in Canada, because what's happening up north was coming to the south. As receipts for retailers were flat in September, according to an advanced estimate from Canada released here today. That followed a 0.1% decline a month earlier, which matched the median estimate from economists. Sales were down in 6 of the 9 subsectors, including car dealers, furniture, electronics, and appliance retailers. Excluding autos, retail sales rose a mere 0.1% versus expectations that it would fall. The report shows Canadians are quickly rolling back their goods purchases as more households face mortgage payment renewals. It's also in line with the Bank of Canada's consumer survey earlier this week, which suggested Canadians who expect more adverse effects ahead from rate hikes are more likely to spend on discretionary items than buy items usually financed with loans, such as cars and appliances. And so we know when people run out of money, the natural thing they do is spend less. Now, initially, what will happen is people will go out, they'll use their credit cards, they'll tap financing where they can, and as they start hearing the word no, or they reach the limits, then eventually the spending stops. And so what we're looking at here in the U.S. is we talked about how this revival in retail sales this week is likely giving people a lot of optimism, including the Fed, that perhaps we actually did experience the soft landing. But the evidence says we're not even close to a soft landing. Perhaps it's the data that's about to take a turn lower. And here you can see advanced retail sales in blue against total compensation. This is average weekly hours multiplied by average hourly earnings of production and non-supervisory employees. So you'll notice that as people have less to spend, and this seems almost obvious, that of course spending goes down. As they have less money, retail sales drops, and you see this happen every time. But now look, you see this kind of jagged line on the trend down, because total compensation growth is indeed slowing. But look at retail sales. You see this kind of rise here, and then we go back and look at the credit data, and we see that revolving credit data popped up, and it says, okay, wait a minute. We know the U.S. consumer still has some credit lines it's tapping. The question is now, at one point, have the banks had enough and say, you know what, we're not going to extend credit anymore, and this is why we're going to be closely watching as we get to the next non-farm payroll report to see, is the weekly hours coming down, which we likely expect it to happen, because it's going to have a major effect on the U.S. economy. And here we can see telecom giant Nokia plans 14,000 job cuts as profits plunge. And this is going to be a headline that we're going to see here in America at some point as companies are going to be forced to lay off. As you see, a massive headcount reduction comes after Nokia reported third quarter net sales plunged a whopping 20% year on year. And profits crashed by as much as 69% year on year from July through September compared with last year. And this is something, again, that most people don't see coming to the U.S. They're saying, look, there's no way. In fact, we think profits are going for U.S. companies are going to go higher. But when you think about it, if consumers have less money to spend, how are corporate profits going to go up? The two don't go in sync with each other. Now, perhaps initially, you'll see companies laying off people to try to maintain their profit margins, but they're still going to come down as money gets drained out of the system, which is a key factor here of what's really happening to the global economy. The CEO acknowledged that the macroeconomic environment will play a significant role in 2024. However, he stated it was too early to provide specific guidance and cautioned against assuming the company would receive support from the market. Nokia isn't the only Western telecom reducing its workforce. Ericsson announced plans to reduce its headcount by 8,500 earlier this year. The slowing global economy and elevated inflation have pressured telecoms, and what we're hearing from the CEO of Ericsson is underlying uncertainty is impacting its mobile networks that will last into 2024. Of course, you'll note that these CEOs are hoping that things turn around by 2024. What they're missing is in 2024, we will be in a recession. There's just no way out of this now. They're all hoping that perhaps central bankers will start to cut rates. We'll take a look at that here in a little bit. But if you start to zoom out and look at the bigger picture, and you can see what's right now just happening in Israel is having a major effect on a different country, one we wouldn't expect would have a problem with this conflict, and their economy is outright collapsing, and it's going to pull everyone down. And so the notion that there's going to be a resurgence in demand, well, what's going to be a resurgence is layoffs. And here you can see when total compensation, this shown in red, declines, what happens is a 4-week moving average initial claims goes higher. And we see this effect every time, even going back to the 1970s. Of course, remember, we had high inflation between the 70s and 80s. But notably, as total compensation goes down, what happens? Of course, layoffs go up every single time. Now, we're not at kind of like an inflection point. We're getting close. But normally at this point, we start to see employers laying off, and they've literally bought into the narrative that we're going to see a soft landing, that there's going to be a revival in the economy, that the central bankers actually have this right. The problem is they don't. Meanwhile, economists boost U.S. growth projections, reduce recession odds. And one thing that we think should be being boosted, well, that's your trading account. Check this out. Our reports showed you this is where you should buy gold, GLD. Check it out, up 6.3%. And this is a huge deal because many of our successful traders are using our reports. Let me show you exactly how they're doing it. They see this on our CTA-Timer Pro. This mimics the machine positioning. We've talked about this before on many shows. And here you can see it went from a deep short position. And this is what we alert our subscribers to watch for. And they started short covering. This is your first signal. The second signal, now this came on October 12th. It happened on the same day our Momentum Timer Pro, which looks at technical indicators, smooths them all out for you. It had a daily buy count. That is the signals you are looking for to put a buy in. And what you can see, that actually turned out to be a 6.3% upside trade. And that is just that simple, my friends, of how to use our two reports together. There are links in the description for both of them. Currently, you have a 14-day money-back guarantee and the first month of Momentum Timer Pro. It's on me, and you can still lock in that $20 price point. There's still a few coupons left. It's not infinite, so get it before it's gone, because one thing that is going to be gone is the U.S. economy, but not to the experts. As the economy probably expanded at an annualized rate of 3.5% in the third quarter, the fastest in nearly 2 years, as forecasters marked up their household spending forecasts. And while growth is seen slowing in the following 2 quarters, economists in the latest survey still marked up their estimates for GDP. But it doesn't matter because we know where GDP is headed. The U.S. economy has a stellar summer. Robust consumer spending has been the main driver, with households keen to maintain their lifestyles. But here you go, by tapping savings and borrowing on credit cards while inflation continues to eat in their spending power. And one thing we know is that total compensation is falling at a rate faster than inflation. So we know consumers are eating away at their savings. We've looked at the total savings rate. We know they're tapping their credit cards. We've looked at that. We've seen all of this happen already. The question is, at what point do their savings get low enough and their credit card limits are reached, and whether spending actually comes to a stop? Well, once that pandemic money is indeed gone, which it should be or very close to being gone, we know there's not much hope left for the U.S. economy. Despite current economic readings coming in stronger, we still expect a mild recession to unfold in 2024. The jump in yields that underpin borrowing rates will engineer slowing in employment and income growth that leads to a pullback in consumer spending. But it's not really that's the reason, because consumers always love to consume. This is something policymakers don't understand. People want to buy stuff, and they love buying stuff. The issue is, can they actually afford it? And the answer is not likely, because when we take a look at advanced retail sales here and we look against the net percentage of domestic banks tightening standards for credit card loans, what happens is you see retail sales growth tends to slow down when banks stop extending credit to people. And I know it seems almost hard to believe, but you'll notice it happens again here during the global financial crisis. Again, banks said, look, we're not giving you any more credit. In fact, you're maxed out. We'd like to cut that. As you pay it down, we're going to reduce your limit. Well, that took a real big bite out of retail sales. We see it here again. Now the notion is that retail sales are going to come rebounding back on hopes of a very strong consumer. And what we're making the case is that at some point, these banks are going to say no more credit. And when that happens, watch retail sales plummet. But now Powell is signaling the Fed to stay on hold and keep future hikes on the table, which is probably one of the best things he could do in a long time. His comments effectively affirm market expectations for the Fed to skip a rate increase for the second straight meeting when officials gather at the end of the month and have their press conference on November 1st. The Fed chief also said in a run-up in long-term Treasury yields, if they persist, could lessen the need for further hikes at the margin. Now, what we've seen is investors and speculators aggressively shorting the long end of the curve, so thinking that, hey, if we keep doing this, that puts Powell on pause, maybe even causes the equity market to go higher here. So you see there's a bit of a narrative, even as we see shorter-term yields following. And he's saying that, look, the underscoring of the importance of tightening financial conditions to the rate outlook over the coming months is what matters, and they are afraid now, and this is something I want you to understand, they want rates to go up slowly so the markets and the economy can adjust to it. They don't like rapid moves in anything. That's not what central bankers want. That's why you tend to see that they'll do 0.25% here and then 0.25% there, sometimes 0.5%, but it's gradual over a long period of time. They don't like to shock the markets. Right now, this big move in the long bond, which is going opposite the direction of the short end of the curve, has got them worried that this is going to have a major problem with the functioning of the U.S. economy. That's why they're going on pause for November, maybe even in December. We'll see what the data looks like, but let's take a look at what Powell had to say. Given the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Of course, what they can't see is what's going on overseas, because if they looked over there, as we're going to get to here in a bit, they would actually understand that this war is causing problems in other countries, and eventually, when other countries have problems, well, we're going to have them too. But here we see again, the Fed remains clueless. As Fed's Raphael Bostic doesn't foresee rate cuts coming until late 2024? Well, I got news for you, Raphael. They're coming a lot sooner than that. And there's still a lot of momentum in the economy, he says. My outlook says that inflation is going to come down, but it's not likely to fall off a cliff. Actually, it's going to fall off a cliff. It'll be sort of a progression that's going to take some time. And so we're going to have to be cautious. We're going to have to be patient, and we're going to have to be resolute. And they're not going to have to be patient much longer, because based on what we're seeing in the data, it suggests that around the world, you look at Canada, we're about to look at Germany, you start looking at China, the only question remains is when does it come to the U.S., and it won't be a whole lot longer, because what Bostic can't see here is the fact that the yield curve, which is still inverted despite traders' best effort to remove the inversion, whenever you see the inversion, it slows the growth of money and inflation comes down. It happens every single time. And so they don't think this is a rapid decline. Well, quite it is. The problem is the next move down will be even steeper and faster than the first move, but they just can't see it. And that's one of the problems and why we started out the story talking about the Israel conflict, because it's having a major impact on a major economy, and this is going to have repercussions for all people around the world, as you're about to see. Because a wider war in the Middle East could tip the world economy into a recession. And conflict in the Middle East can send tremors through the world, because the region is a crucial supplier of energy and a key shipping passageway. We note that the Arab-Israeli War of 1973 led to an oil embargo and years of stagflation in industrial economies. Problem is, we're not going to see stagflation anymore, because when people hit the unemployment line, well, their spending's going to go down, particularly when they're sitting on massive amounts of debt. But now let's head over to Europe and into Germany, where we find out the ugly truth of the unthinkable. As European markets open at a 7-month low on stuttering global sentiment. So you notice that is the first factor here is the markets don't like what's going on. They're running out of money. Remember, these sky-high valuations, these sky-high stock prices, they need money to keep them going. We're slowly seeing it drain out of the global economy. And now look at this. European junk bonds fear gauge climbs the highest since March as higher for longer rate bets and geopolitics hurt risky assets. And this is not exactly what you want to hear at all in terms of a soft landing. These are things you start to hear when right before a big crash. And now let's look at Germany, because here's where it gets ugly as German producer prices post the biggest decline on record into September. Now remember, it wasn't long ago we talked about Germany, and what was the whole part about it is they were about to see a huge revival. They had data was just starting to turn around, and everyone was hopeful, and we said, don't count on it happening. We're likely to see another leg lower. Now we're seeing it in producer prices, and wait till you see what that means for consumer prices and overall demand of what we're about to see in the U.S. As German producer prices posted their biggest year-on-year decline in September since the data collection began back in 1949, spurring hopes for further easing of inflation in Europe's largest economy. Well, not to worry, they're going to have an inflation problem much longer. As producer prices fell slightly more than expected in September, decreasing by a whopping 14.7% on the year, according to the latest data. Now, what does this mean to the U.S.? Of course, we got to look at our producer prices and assume that if it's coming down in Germany and they're being affected by the war, which we know they are, that it's going to continue to affect other countries and demand's going to evaporate. And next thing you know, where does consumer prices go? Well, here's why. If you look at producer prices, this is for final demand against U.S. consumer prices, have both shown on a year-over-year rate of change. And where producer prices go, well, you can see that consumer prices follow, suggesting, as what we know is likely to happen, that as demand continues to come crashing down around the world, inflation's going to evaporate, it's eventually coming to America, and central bankers are going to find themselves not thinking about a cut in 2024 toward the end of the year. They're going to be thinking about how fast they can cut, because once demand comes spiraling down, rate cuts aren't going to stop it. It'll be too little, too late. The central bankers inverted these curves far too long. They've constricted the supply of money growth, and now we're about to pay the ultimate price. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.